Welcome, welcome, welcome. If this is your first time tuning in, my name is Andy Green with Green Group Real Estate, and I am joined, as always, by Annie Ransom with All Pacific Mortgage. Say hello, Annie.
Good afternoon, everybody.
And today, what are we going to be talking about, Annie?
Oh my gosh, we're going to talk about mortgages, real estate market.
Yep.
Continuing this COVID-19 saga.
Because that's what we do. Our ultimate goal is to provide you guys with the information that you need to make smart choices both today and as we move through COVID-19, because there are so many changes and so much stuff that's going on. And I think the hot topic for today is credit and credit challenges and the lack of available credit and the tightening of the credit market. Does that sound about right, Annie?
Sounds right.
Okay, so we are going to dive right into it. But before we do, if this is your first time tuning in, please leave us a comment. If you have any questions, any burning questions that are on your mind, you're wondering what's going on with either the real estate market or the mortgage market, that is what we're here for, to give you guys that information. So make sure that you leave a comment, and this is going to be your little reminder. So look at that. Comment with your questions and we will answer it live. And if we don't get to them live, then we will be going back. We'll look at these and we'll answer any questions that are left undone. Sound good?
Sounds great.
Okay, so let's dive right into it. Annie, tightening credit market, a lot of changes. Walk us through what's going on, what it means to consumers, and what they need to do to set themselves up for success if they're thinking about buying in 2020.
Yeah, absolutely. So a lot has happened over the last couple of months with lenders and what they're doing, what they're offering, what they're expecting. So just to put this into perspective, prior to COVID hitting, folks could obtain financing with as low as a credit rating as 580. Those days, unfortunately, are very limited. Typically, banks want to see credit ratings over 640. There are a couple of options below, but you're going to pay for it. So interest rates are going to be a lot more expensive. What they're requiring in order to get into these loans with less than stellar credit is a lot more stringent. So they want cash reserves. They definitely want job stability. That's going to be the case no matter what your credit rating is. So if you're somebody who is on furlough or you've been laid off or whatnot, then unfortunately you have to wait until you're back at work and back in line. So things are definitely a lot.
Hey, Annie, I don't know if you can hear me, but I'm getting some feedback here from, and not really hearing you. You're frozen. So somebody, please comment and let us know if you guys can hear Annie. So there is a comment in, let's see. We are refinancing right now. Well, today is definitely a good time to be refinancing. Hey, Beth, since you're watching here live, can you let us know if you can hear Annie? Just leave me another comment.
Am I still frozen?
No, I can see you now. You seem fine, but I want to make sure that everybody got what you just said, because this really is critical for today's home buyers that have been planning on making a move, that have possibly even put pieces in place. Well, that stuff has changed, so they've really got to listen. And why don't you just kind of give us a real quick recap of what you just went through, just to make sure.
Sure. So credit guidelines, they're tightening. Banks are really concerned that because there are so many forbearances right now, forbearances are up to 17% right now. So banks are really concerned that if they issue these loans, that people are not going to have the ability to move forward and keep making these mortgage payments. So awesome. Thank you, Beth, or thank you, Jennifer. So So for those people who do qualify, of course, Beth just mentioned that she's refinancing right now at 2.99, which is phenomenal. These interest rates are, I mean, insane. So Andy made a comment a little bit earlier, if you saw his Facebook post or an Instagram post about the rumor mill of interest rates going down, right? So
to 1% is what I heard. I have no idea if that's true. I know that there's a gap and they could potentially go down to 1% because there's room based on like what's happening with, I think it's the Treasury note, but like, is that real? Could they go down to 1%?
I mean, the hard thing is that there's no true way to predict what happens in any market. Otherwise, we'd all be rich, right? If we could time the stock market or the bond market, we'd all know how to make money a lot quicker than these people who completely specialize in it, right? There's no algorithm that they've been able to create to make money in the stock and bond market. But what we do know right now is that, you know, several weeks ago when interest rates dropped significantly and then they jumped back up, it's because nothing's normal in the markets right now. There's so much uncertainty. We can't predict, you know, what is going to happen. But what we do know in the mortgage industry is that rates are nice and low right now. People like Beth are getting a 2.99% interest rate because the Fed is buying up these mortgage-backed securities. That is the only reason that rates are at these lower levels. And it would be very expensive for the Fed to invest enough in buying up these mortgage-backed securities for rates to go below, I mean, really much lower than 3%. Mm-hmm. So, and what banks are concerned with is their ability as interest rates reduce or as they're at these lower levels, having the ability to manage all of these loans that are coming through, as well as the bonds that are being purchased don't support interest rates much lower than where they're at today.
Okay.
So it's Beth, don't be too concerned. 1%, it's very, very unlikely that 1% would happen again, because the Fed is going to, interest rates have been very stable for the last couple of weeks, and we anticipate that they will continue being that stable because we have to have people continue to buy loans to stimulate the economy, to purchase real estate, to get into a nice interest rate that's going to sustain. And that's where we're going to see things at. It's possible we might see a small fluctuation as things continue over the next couple of months. But for the most part, we'll see them stay nice and steady, at least over probably, I would say, the next 6 months or so. So.
Well, that's honestly what I would expect. When I heard that or I read it, I can't even remember where it was, but you know, if you read something online, it's more than likely true. So I'm just going to go with that. We're going to see 1% interest rates for sure. I saw it online.
I mean, my concern is that when people bank on the fact that rates are going to go lower, you are putting yourself in a position to where you're not going to be able to take advantage of them when they're at this level, right? So, you know, interest rates, the average interest rate is 3.25%. So anything within that range, sure, interest rates can always go lower. Sure, the Fed may continue to pump money into these markets, but again, there just isn't enough information to support interest rates going lower than these historical lows that we're at right now. We're lower than they were during the housing crisis back in 2006 through 2014.
Right.
So,
right.
You know, waiting for that to happen is not sound advice by any means. So like we talk about every week, the best that we can do is make educated decisions based on what's happening. And things could change at any time. The Fed can decide that they're pulling out of buying up mortgage-backed securities, which they've talked about doing. And once that happens, we will see interest rates go up. Various investors, because they're on the hook for people going into mortgage forbearance. So forbearance, for people that don't understand that term, that means that you're certifying to your investor that you can't make your mortgage payment, and they're allowing you to forego making that payment at least until a later date. So they're either collecting a balloon payment at the end of the forbearance period, or they're tacking that amount on to the end of that loan. So if I'm a lender and I issue a brand new loan, because of the state of what's happening in the economy, and you immediately, as my borrower, go into a mortgage forbearance, I'm in big trouble. I'm in really, really big trouble because I want to sell that loan on a secondary market in the form of a bond in order to make money and free up cash to continue lending to other consumers. So when I don't have that ability, I'm in a bad position. So for a lot of these lending institutions, that is the biggest concern that they have. And if that is to occur, if it's a Freddie Mac or Fannie Mae backed loan, I'm paying really big penalties to these institutions that back that loan. So the chances of interest rates going up is a little bit heavier than the chances of interest rates going down. So let's hope that we ride them out at the level that they're at currently so that people can continue buying real estate at these really insanely low rates. And that our economy can sustain before we start, quote unquote, getting back to normalcy, which interest rates, let's be honest, even in a 4% range are lower than normal. So we've been
normal, let's call it the average over the past, I don't know, 50 years. Isn't it closer to like 7% is the historical average, around somewhere, give or take, probably a little bit higher than 7%. Is that about right?
Right.
And they're at just over 3% now. Could they go down a little bit? Maybe a little bit. Are we expecting them to go down to 1%? No, probably more than likely not. A couple questions that I have about something that you just mentioned. You talked about, I can't remember how you put it, but what it made me think of is you guys have been going through this refi boom. Like I think Beth mentioned, she's getting 2.99, which is awesome. Has that slowed down at all? Because I know that purchases are up. I think I saw that they're up well over 10%. What's that number? Do you know?
Say that again. What's the percentage of
purchases? So the percentage of purchases versus refis.
Yeah, sure. Refis are about 70% of the market right now.
Okay.
Mm-hmm.
But have you seen your purchase business go up? So people that are looking to actually buy a home and not refi?
Oh, sure. Absolutely. We're also headed into sort of a traditional peak season, right, of purchases. But yeah, absolutely. It seems like the scarcity mindset has calmed down a bit. Applications, overall mortgage applications are up about 5% over the last couple of weeks. So there's good positive momentum. I think people are starting to feel a little bit more comfortable. And the good news is that, people are in a good financial position in terms of equity that they have in their homes. So they're either using that equity to get themselves into a move-up situation. But a good majority of people who are in the healthcare industry, who are in the tech industries, who are in the financial industries, those are still very healthy industries that are supporting purchases right now. So we'll continue to see that grow.
Okay. And one other thing that you mentioned, you talked about forbearance and there being a balloon payment at the end of the forbearance period. Is that typically about 6 months?
Someone can apply for an initial forbearance for up to 180 days. And then at the end of that period, they can apply for another 180 days.
Okay.
So it depends on the person's situation and what they individually need. It's not automatically 6 months. It could be a month. It could be 2 months. It could be 6 months. But yeah, the concern is that the way that these forbearance agreements are written up, typically it is a balloon payment, meaning for all of the months that have been missed, that total amount is due at the end of the forbearance period, which, as you can imagine, if you're not making money, if you're on furlough, or if you've been laid off and you're not bringing money in, there will be a challenge to make 6 months worth of mortgage payments at the end of that period. So
like nearly impossible.
Nearly impossible
for most people. Yeah.
Right.
Okay. As we wrap up the mortgage segment, what can consumers do? What can home buyers do to make sure that they're setting themselves up for success and putting themselves in a position to accomplish their goal of buying a home?
Sure. Yeah. I think that there's a lot of different things that people can be mindful of. I think really evaluating your debt versus asset position. So accumulating assets is number one for everybody. Analyzing the cost of what it's going to take in order to purchase a property over time, which folks like Andy, folks like myself, we can, take clients through sort of a step-by-step of here's what you need to do in order to plan for this. Paying off consumer debt. That's a really big thing, right? A lot of people are learning a tough lesson right now based on the amount of debt that they have, and their debt is increasing because a lot of people aren't in the workplace right now. So really evaluating that moving forward and creating a strategy to eliminate consumer debt. And then analyzing, overall what this property will potentially do for you. Locking in your cost of living, which in my opinion is the number one reason to buy real estate. The tax write-offs and the appreciation, those are really great advantages. But the number one reason is to lock in that cost of living. And we're going to see the cost of living really dramatically change over the next couple of years based on everything that's happening. So I think taking into consideration those pieces will allow somebody to plan for whether or not it's the right time to buy, and what actually buying is going to do for them in the immediate, short term, and long term.
Yeah. And I also think that smartest thing to do, in my opinion, is to just have a conversation. If you have been thinking about it, then pick up the phone, send a DM, text, whatever you do, but just have a conversation with a professional like Annie that's going to walk you through your options. See, if you are a borderline borrower, or what you can do to put yourself in a stronger position. So when the time comes, you're able to make a move. So it's just reaching out, having that conversation, starting a relationship with somebody that you trust. Number one.
Agreed.
Okay, let's move on and let's talk about the local real estate market. So last week we had talked about numbers for the first quarter of last year. And what we saw really was that they were very similar to what we saw in the first quarter of 2019. Not a huge drastic difference. But if you look at the most recent numbers that came out for April, which COVID hit in, around March. So early March, mid-March, we started to see some dramatic changes which affected the local real estate market. And if you look at this local market action, which is a publication of the Regional Multiple Listing Service, they track all the numbers here locally. You look at the new listings, pending sales, and closed sales are all down dramatically for the last month, which is what we would expect. So new listings down 32%, pending sales down 34%, and closed sales down 16%. So are those super important to know? Probably not the most important data, honestly, because we knew it was coming. We had a forced shutdown. But I think what we can focus on is look at the average sales price increased 4.3%. So comparing 2020 to 2019 through April, the average sales price has increased 4.3%. I think that's the most important metric that you can look at. If you're a homeowner, you own your home, you have a lot of equity, which we've talked about that. Homeowners have, a lot of equity in their home. Is that safe? Is it going to go anywhere? And based on what we're seeing, average sales prices staying steady. And I think what I attribute that to, and just selling a lot of real estate and working with a lot of buyers and sellers, is that the lack of inventory, and it did go up from 1.8 to 2.4 months of inventory, but it's still dramatically lower than the average, what it should be, which is probably 5, 6, 7 months. So when you combine the low inventory and interest rates as attractive as they are right now, around 3%, there are a lot of motivated, active buyers in the marketplace. So we're seeing a lot of multiple offers, which increases, just holds those values steady in the area. It's definitely more challenging for home buyers when you're competing against multiple offers. But if you have a really strong real estate agent that has the experience and knows how to navigate those tricky waters using contingencies and also putting buyers in a position to win in a multiple offer situation, then you're going to be in a pretty good spot. And on the flip side, for sellers, homes are selling very quickly, and for top dollar, they really are. So the homes that are positioned correctly, you do some upfront work to get them ready for the market so they stand out against the competition, then you are going to be putting yourself in a good position to accomplish your goals. So 4.3% increase in the average sales price in the local metro Portland real estate market. Let's see what else is here. So we had inventory, and that's it. So those are kind of the key takeaways that I took. I think the bottom line is that we have a strong, healthy real estate market. We have good economic indicators on the back end. Some are going to be skewed, and unemployment's going to play a big role in what happens moving forward. But the rest of 2020, I personally see us on an upward trajectory. I think that home values will continue to stay steady. We will see an increase in inventory in the market. But the outlook for 2020, I think, is probably better than a lot of people would have predicted as we went into COVID.
In terms of real estate.
Yep.
Yeah.
Yep.
Yeah. Well, and I think that, basic economic 101, right? Supply and demand are what drive the market, which is why we're seeing those property values increase. So 3 to 5% is normal appreciation for properties each year. And so we're right in the middle of a very healthy market right now. But you're seeing that even with listings going down, that just shows that there's still a big enough demand to where property values are going to continue to go up. So that's really good positive information. That's awesome.
I think so. I'm excited about the rest of the year. And as I mentioned last week, if I went back and listened to a prediction that I had for 2020 and what would happen with appreciation, and my prediction was about 4%. 4%. So it's staying about where I expected, and I will take that all day long, considering what we're going through right now. So if you found value in this today, we would love to connect with you online. We're on Facebook, Instagram, YouTube. We're constantly trying to find ways to add value to you guys and give you the news that you can use to make smart decisions both today and as we move through this whole COVID situation. So next week, we are going to be talking about how to stage your home to sell. So doing a little bit of upfront work, getting your home ready to sell, is going to be crucial in today's market to separate your home from the competition. And it doesn't take a huge budget or a ton of work to make that happen. It takes a little bit of work up front and maybe a little budget, just depending on your home and what it needs to be ready for market ready. So that's what we're going to be talking about next week. Next week, live stream, 12:30 on Monday. Live with Andy and Annie. We will be back at you again. And if you didn't see one of our last videos, we talked about what's going to happen with the real estate market moving forward. I will post a link right here or right here, one of those two, and you guys can go check that out as well. Some really good information. We did an interview that will knock your socks off and give you news that you can use. So I hope that, thank you guys. Thank you everybody that tuned in live. If you're watching the replay, thank you for checking us out. Make sure that you hit the subscribe button. If you're watching us on YouTube, give us a thumbs up. We'd love to see your comments. So go out and make it a great week, friends.
Love it. See everybody next week. Thanks, Andy.
Thank you, Andy.